We pay more in the U.S. to service the debt and interest costs than we do in our military budget. It's the second largest line item behind the entitlement spending. And that's just going to get more and more out of control. We're in that kind of terminal exponential phase of this debt crisis.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for January 29th through February 5th, 2024, while supplies last. This week we have silver Valcambi or Asahi 100-ounce bars at just $1.39 over spot per ounce. We also feature pre-1933 gold $10 and $20 Liberties at $89 over melt and $139 over melt, respectively. Next, backdated 1-ounce silver maples are at $3.75 over spot with a minimum order of 50. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Craig Hemke from TF Metals Report. Craig, thank you so much for joining us today.
Elijah, it's always good to see you, my friend.
Well, it's great to have you today. And the news we just got out, we're recording this at 2 p.m. Eastern time on Wednesday, right after the Fed's announcement that they're going to be holding interest rates steady. Your perspective on that, and I'd like to get into your outlook for 2024 that you posted a few weeks back. But if you wanted to if we could first get your reaction of the Fed holding rates steady.
Well, holding them steady was exactly what everyone was expected from the Fed today. Shortly, we'll get a press conference from Powell where I'm sure when pressed, he'll seem a little more dovish than perhaps what these headlines are. But holding them steady is what the market had settled upon. What has been most curious and what has been driving the gold price here so far in 2024 are those changes to the rate cut expectations. As we got toward the end of 2023, the likelihood of a rate cut in March had grown to 90%. And I was telling people on my side, that's crazy. I mean, we're talking that's, 90 days from now. No one knows what the world's going to look like by 90 days from now. And so to say with 90% certainty that the Fed was going to be cutting rates by the middle of March, I thought was just out of left field. And so I began warning people on the site that we should expect kind of a challenging January as those rate cut expectations come back to something more reasonable, like 50-50. Because that would be about right, you would think. And that's where those rate cuts expectations came down to. And now with these somewhat hawkish sounding Fed lines out of the Fed today, I'm sure it's less than 50% for a rate cut in March. That's been the primary driver of the gold price. And when I wrote my annual forecast, which I do every January, in order to kind of mostly go sideways, that's what we're doing so far. As everybody waits to see when will the Fed start cutting. A lot of people out there still think it's going to be March just because of liquidity needs as the reverse repo fund runs dry and as that bank near-term funding program that the Fed introduced last March goes away. That may drive rate cuts as soon as March. But for now, I think we all have to be on standby, and gold is reflecting that by mostly going sideways.
Now, in your macrocast for 2024, you pointed to a lot of different specific macroeconomic factors that we should be looking at right now. One of them is the reverse repo and how the balance is going to be going to zero, it looks like around the March timeframe. So if we wanted to start with that, because I know you mentioned that is really a big question for 2024, how do you think that will impact the markets?
Well, I think that's a great place to start because that's really the primary thing that I got wrong in 2023. I tell everybody I write these forecasts for me. I don't write them for clicks. I'm not trying to show how smart I am because that would be a futile process. I write them for me so that I have a written record that I can refer back to as the year goes along. And when I get things wrong, I can look back and go, oh, okay, well, I guess I know why I screwed that up because, such and such maybe never happened. Well, I look back at 2023, I was expecting a recession to begin by later in the year, August, September, something like that. And I just did not think there was any way that the markets could tolerate interest rates higher than 3.5% or 4%. We got that high in the late 2018, and liquidity dried up, and the stock market crashed, and the Fed paused and then pivoted and everything else in 2019. I thought, well, the same thing will probably happen here. And what I missed, at least I think, was that reverse repo balance. The Fed had created, $4 or $5 trillion in new cash in response to COVID. And a lot of that cash got out chasing goods, and that's what drove that inflation spike. But by late 2022, there was over $2 trillion of cash being quarantined, if I want to use a COVID term, in this reverse repo account at the Fed. The banks were parking these excess reserves at the Fed, earning interest on that money. And that money was not out circulating in society and exacerbating inflation. And ultimately what happened in 2023 is that money started coming out, provided a bid for treasuries to keep rates from getting completely out of hand. It flowed out into the markets where it got levered and, went into the stock market and everything else. And liquidity never did dry up. Problem now is it's beginning to. That account peaked at $2.3 trillion in late 2022, and now it's down currently less than $600 billion. So what happens when that goes to zero? Well, we're probably going to find out sooner rather than later. And that's something that, like I said, I think the Fed will have to take into account as they move to stop their quantitative tightening and eventually start easing this year. And that's what I missed last year. That balance provided the liquidity that I thought was going to dry up and prompt the Fed. Balance will eventually dry up, and it will prompt the Fed to act. It's just a little bit later than what I thought.
Now, I think it's been said that this program has it obviously has given liquidity to the banks, but as the Fed has been hiking rates, it's been kind of a secret way to do monetary easing in a sense. So why do you think inflation actually, in fact, has come down, if you look at the official numbers, I guess, even though there's backdoor easing going on?
Well, there's a couple of things going on there. I mean, demand has eased in a number of areas. Remember, it was a lot of huge surging prices in odd things like automobiles, used cars, things like that. Food costs were soaring as well. Energy costs were soaring. You remember, price of crude oil got up to almost $100 a barrel. That, through a number of factors, has been brought back down. And so input costs have come down too. The money supply, as measured by M2, has shrunk dramatically and at the fastest rate maybe we've ever seen. And so they've been able to control that massive amount of dollars, where you had the classic inflation of too many dollars chasing too few goods. And we've kind of gotten that more into an equilibrium now. I don't think that's here to stay. And I think eventually the Fed's going to be forced to choose between fighting inflation or providing liquidity to keep the government operating and then to keep the markets flush with cash. Some people think that Powell will err on the side of responsible monetary policy for the masses and try to wring out inflation through higher interest rates. I think that's crazy. I think the precedent has been set multiple times over the last 15 years. When push comes to shove, Powell will kick the masses to the curb and instead provide the liquidity that the government needs in running these $2, maybe $3 trillion annual deficits, servicing that accumulated interest and the debt costs, but also liquidity that the markets need to keep operating as well. That's what they've always done in the past at the Fed. I think that's what they'll do again. And when push comes to shove, that's a decision they'll make this year as well, regardless of how hawkish they may be sounding today about fighting inflation.
Now, when it comes to the Fed policy, you mentioned in your article that really it has so much impact on metals prices today. And it's kind of odd that everyone is just looking at what the Fed is doing, because there are a lot of other macroeconomic factors to look at. But at the same time, there's so many, essentially computers that are trading the market now. Most trading is done by computers, and they're really looking at the Fed policy first and foremost.
Yeah, and think of it as almost like a bifurcated pricing scheme. Over the last, today we were actually up, as we're recording this on the 31st, but over the previous 10 days, the price of gold as it's traded on the COMEX has plunged dramatically between about the 8:30 Eastern Open and maybe 10 o'clock. All of that coinciding with maybe some stronger than expected inflation or economic data. And that has caused a reset of those rate cut expectations. So during U.S. hours over the last couple of weeks, and really this entire month of January, the price of gold has gone down. But over the Asian and London hours, it's been rising. And the two have kind of counterbalanced each other. And gold is year to date maybe down $10 as we wrap up the month. So you've got this kind of bifurcated thing where physical buying is driving price in Asia and into London. But as soon as the price action shifts to New York, we get these headlines. The machines that trade, the HFT machines that trade COMEX futures, see those headlines and see the changes in the rate cut expectations, and they dump their gold and silver contracts. It's very interesting to watch. Sometimes those machines are driven by changes in nominal interest rates, bond market moving up and down. Sometimes, a lot of times during the day, they're driven by the dollar index. But right now, the only thing that seems to matter are those rate cut expectations. How soon will the Fed start to cut? Again, may still be March. Curve's starting to look more like it might be May. We played this game last year and they made it all the way through the year. I don't think they'll do it again this year. Gold is waiting for that shift, that shift back to cutting. And that'll start generating the positive momentum and the interest in gold that should push it finally through 2100. But we're just not there yet.
And you mentioned in your macrocast that there's a lot of uncertainty out there, but you still dare to give a price point for gold and silver towards the end of the year. You mentioned how gold, you think, will break above into new high territory around 2,300 and settle back to 2,200. And then silver will end the year around $26 or $27, going as high as 28. So a pretty conservative view, it would seem like. But can you kind of give your defense of those numbers you give at the end of your article?
Well, I've never been one to do this, hyperbolic, to the moon stuff. Under this current pricing scheme, it doesn't work that way. Now, gold has rallied this century from $300 to $2,100. And if you annualize it out over the first 23 years of the century, it annualizes about 9% a year. Okay, so it's not that price can't go up. It's just that it's not profitable for the banks that manage the markets to have it go up 50% in a year. Okay, they can handle 10. 50 would be a disaster. And so all I'm really predicting, at least for now, is another average year, about a 10% gain in gold. And then extrapolate that out to silver, maybe 15, maybe 20% in silver. Now, everybody wants, I want it to go up 100%. I want it to go up 100%. What am I saying? But I just don't expect that this year. There's just a lot going on. And the Fed is going to act to try to keep as much stability as possible into the election and through all the geopolitics and everything that goes with it. Now, we get to 2025, and we'll see where we go from there. But I would think for this year, with the Fed finally pausing and then pivoting, we will get that breakout above 2,100 that I was looking for last year, a rally of probably 10% up to about 2,300 at some point this year before settling back by the end of the year. Silver has that same trading range that gold's been in, but it's having even a more difficult time of breaking out. It has to get above 26 before it can even think about getting above 28. I think that move to 26 will happen this year, but I'm not sure it'll break out above 28 yet. Once it does, once it starts trading with a number that begins with a 3 again, okay, then we're going to start having some fun. But I don't expect that to happen just yet, which gives everybody still more time to accumulate physical metal at prices that are still pretty reasonable.
Yeah, pretty much half of where we were back in 1980 at the top, which is pretty impressive that you can still get something cheaper now than it was in 1980. A lot of people have argued that the gold-silver ratio has to fall significantly to go back to where it really has been over the last century on average, or, throughout history, it's been closer to 10 to 20 to 1, somewhere around that area. Your perspective on that, you mentioned that in your article, but you're not seeing any dramatic moves in the gold-silver ratio, it seems like, at least this year.
Yeah, that's kind of the creation of traders, and people that play that ratio. It gets closer to 100, you start swapping into more silver from gold. It goes back down to 70. You go back out of gold back in, or go out of silver back into gold. That's that sort of thing. To me, again, yeah, historically that ratio has been reflective of the available supply, or what's in the ground for gold and silver, and something 12 to 1, 16 to 1, something like that. The fact that it's 90 to 1 gives you some idea of the leverage involved, in creation of all these different digital forms of precious metal in both gold and silver. Under this current system, people follow it though, and we get frustrated because, as you said, silver just kind of trades sideways. It's down 50% from its highs. It's up 50% from its lows, however you want to look at it. And people think it's never going to break out. No, maybe it won't. I don't know. But I do think gold will. And demand for gold is so strong at the central bank level, and just from institutions and funds and high net worth people, the demand for physical gold is not going to go away. So as gold continues higher, it almost has to drag silver higher by virtue of that gold silver ratio. Let's say a couple years from now, gold's trading, you pick a number, Elijah, $3,000 an ounce. Well, a gold silver ratio at 100 implies $30 silver. And if you think that's, crazy, well, maybe it should be 80. Well, what does that imply? $35, $40 silver? So I just can't imagine that silver won't tag along, at least if I'm right about gold. And so that presents an opportunity in silver. I'm not sure. I'd love to see it. Don't get me wrong. I mean, all the silver I've got, I want silver to go to 50 and 100 too. But I'm not sure that's coming yet this year. Again, hopefully it does. But I think this year is more of an opportunity of recognizing that there is a floor under price. And every time price tends to dip, it's an opportunity to acquire more physical ahead of what's to come eventually.
Now, what about the debt crisis? It's interesting. I know my father Dunnigan mentioned this on another podcast, and he was saying how, people kind of see the debt crisis was last year and we got through that, when in reality, no. I mean, the U.S. is still in a debt crisis. We never really get through that unless the debt starts going down and we start paying it off. But it seems to just continue to exponentially become larger and larger. Your perspective on that, do you see any new developments in that this year?
Well, it has to, Elijah. If the politicians always talk about balancing the budget and all that crap. That would be it'd be a horrible outcome for the markets, because the markets are based on debt, and they need a constant supply of debt, which is more money to fuel the beast. Okay, so we're now running $2 trillion annual deficits in the U.S., $508 billion in the first quarter alone. Interest to service the existing debt at $34 trillion plus. We pay more in the U.S. to service the debt and interest costs than we do in our military budget. It's the second largest line item behind the entitlement spending. And that's just going to get more and more out of control. We're in that kind of terminal exponential phase of this debt crisis, okay? You just have to borrow more to keep the plate spinning. Your borrowing costs go up. If interest rates go up, they go up that much faster. Ultimately, what this will lead to is renewed quantitative easing, where the debt is actually just straight up monetized by the Fed, and they'll probably do it through some form of yield curve control policy. The Fed instituted that back in the 40s and the early 50s to try to get the debt under control coming out of World War II. The Japanese have been playing this game since the 1990s, okay? That's where the Fed is headed as well, where they just simply say, look, the U.S. government can't afford this level of interest rates. We are a buyer of all treasuries, anything above 3%. And they'll create just a cap on interest rates, above which the Fed just says they'll buy everything. That's what yield curve control does. That is, again, more quantitative easing. That's more fiat money creation, devaluation of the currency that leads to higher and higher gold prices. That's the only way out. I think it's funny. I've read so much analysis of people that think Powell is somehow fighting for the little guy, right? He's going to sit here and he's going to raise rates as high as he has to. Hell, that's what the FOMC minutes said today, or the headline said today. Oh, we're not going to cut rates until we see inflation get under control. That's pretty easy to say when the markets are still afloat and the regional banks are still afloat, and at least there's enough cash for now in the Treasury to pay the interest and fund the government. But when push comes to shove and the markets begin to crash because liquidity is dried up, I don't care what the inflation rate is. Powell's going to cut interest rates and he's going to restart QE and put on yield curve control because in the end, he doesn't care about the masses. What matters to him is what happens to the banks and to the federal government. That's who he is beholden to, and that's who he will serve. And he will be cutting rates, and he will be starting the money printing machine again just to keep everything spinning. That's what they've chosen every single time there's been a crisis since 2008. That's what they'll continue to do this year, too.
Well, thank you so much for joining us today, Craig. It will be definitely interesting as this year progresses to continue to track this with you. If our viewers are interested in learning more, I'll put the macrocast in the description of this video. And also, did you want to share with our viewers where they can find you?
Yeah, tfmetalsreport.com. I remember telling people last year at this time, nothing could be more important that you get as much objective and independent information as you can, man. If you just end up swallowing what they tell you on CNBC or Bloomberg, you are going to be led astray. So please check us out. It's a great online community, free of trolls. It's a place where we can all share information freely and help each other see ourselves through this storm. tfmetalsreport.com, $15 a month. I think it's money well spent. So thank you for letting me plug it, Elijah.
Of course. Any last thoughts before we let you go, Craig?
Well, let's watch where we go from here. The rest of this week's going to be very busy. Any hawkish sentiment that might come out of this FOMC meeting could very well be buried by Friday with the next jobs report. Anyway, just take advantage of prices where they are to get yourself some sound money. That's all I can tell you. The prices are not going lower for any sustained period of time. And in the end, sound money will triumph just like it always has in the past. So take some dollars. Take whatever you're saving in dollars, euro, Canadian dollars, whatever, and convert it into gold, convert it into silver for your own financial protection. Do it while there's still time.
Greg, once again, thank you so much for your time, and God bless.
You too, Elijah. Thank you.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for January 29th through February 5th, 2024, while supplies last. This week we have silver Valcambi or Asahi 100-ounce bars at just $1.39 over spot per ounce. We also feature pre-1933 gold $10 and $20 Liberties at $89 over melt and $139 over melt respectively. Next, backdated 1-ounce silver maples are at $3.75 over spot with a minimum order of 50. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.